I'm Donna Rayburn. I am a certified business intermediary, business broker, and I am a CPA in the Tampa Bay area. I've been practicing for many years in this area, helping sellers get their business ready to put on the market, and I've helped buyers understand the financials of the prospective company that they're looking to buy. So now I can do the whole transaction from start to finish. So I can get the business ready to sell. We can sell it. I can find buyers for the business. So that is what I love to do, and that's what I've been doing for the last several years.
Hi, I'm Ann Griffith, a business broker with the Exit Strategy Company. With a background in finance and sales, I help business owners sell their companies the right way, confidentially for top value and with the right buyer. From start to finish, I make the process simple so you can focus on your next chapter. And can you break down what an asset sale is and just what it consists of and how is it treated from a tax perspective?
Yes. Yeah, there's two different kinds of sales that you can have. You can have an asset sale or you can have a stock sale. And from a tax standpoint, they're treated very differently if you're the seller, well, and a buyer. But from a seller standpoint, because I just ran into this with a seller that had a lot of fixed assets, so they're taxed differently. So an asset sale is the most common. That's what I see 90% of the time. And an asset sale is really good if you don't have very many fixed assets or much inventory, if you're a service business, if you don't have a lot of contracts with either vendors or customers, it makes it really easy. If you do have a lot of equipment, machinery, vehicles, it's not great. And if you have a lot of contracts with customers or vendors, it makes it a little more challenging. But the tax treatment for a buyer is very good in the scenario that's not so good for the seller. But the buyer, from a buyer standpoint, when they buy with an asset sale, they don't take any liability from the business. So they're just buying the assets, which are if they have fixed assets or inventory, and then mostly goodwill. The customer list, the employees, the brand, the reputation. That's it. They're buying just those assets. So if there's some lawsuit out there against the seller that has nothing to do with the buyer, and they'll never be responsible for that because they're only buying the assets of the company. So it's very desirable from a buyer standpoint to have an asset sale.
Great. And then how does the stock sale differ from that?
So they're less common, and they really only happen in small business. And when I say small business, I'm thinking 5-6 million in revenue and under. Stock sales aren't as common unless they have a lot of fixed assets. Like I actually have a client that has they've got about $6 million in fixed assets, equipment, machinery, vehicles, and so from a tax standpoint, the seller is taxed at ordinary income rate, which, if they're going to sell it 5, 6, 7 million, they're going to be in the highest tax bracket. So they're going to be paying 37% tax on that. Versus if it was an asset sale, that's what they're going to be taxed at. And if it was a stock sale, they would only be taxed at the maximum, the 20% capital gain rate. So if you have a lot of fixed assets, it's better to have a stock sale. Also, if you have like a ton of contracts, like long-term contracts with, 100 vendors or 100 customers, if you have an asset sale, remember, you're only buying the assets, you're not buying these contracts. So every single contract has to be redone in the new company's name in an asset sale. But in a stock sale, you're buying the company, so the contracts stay in place. So it's a more seamless transition. So, the buyer in a stock sale takes all the liabilities of the company, good, bad, relationship, everything, because you're buying the company, not just the assets of the company. So it really just depends on the situation, which is the best treatment.